Welcome to the Region's Wealth Management Economic and Market Roundtable discussion. I'm Jeremy King, Vice President of Corporate Communications at Regions. Joining me are Regions Asset Management Chief Investment Officer Alan McKnight, Regions Chief Economist Richard Moody, and Senior Vice President for Public Policy Chris Scribner. We're talking about uncertainty in an uncertain world. That title holds true for so much of what we're dealing with these days. This discussion, though, focuses on the uncertainty involving the presidential race and Brexit, and how both events are impacting the markets and the economy. Before we get into the heart of the discussion, our legal and compliance groups have asked me to highlight disclosure information. Trust and investment management services are offered through Regions Wealth Management, a business group of Regions Bank. The opinions expressed in this discussion are those of the presenters and not necessarily of Regions Financial Corporation or any of its subsidiaries, and the opinions may change. Now, to the core of this discussion. Let's begin with last month's referendum for the United Kingdom to leave the European Union. Alan, due to the amount of uncertainty surrounding that vote, we have certainly seen some swings in the markets.
We certainly have, and I would quote one of the founders of the former Soviet Union, Vladimir Lenin, when he said there are decades when nothing happens and there are weeks where decades happen. And we think that's indicative of how the markets have responded to the Brexit vote. I was actually on a flight coming back from New York the evening of the Brexit vote, was boarding the plane at 11:30 at night, and it was 50-50. And if you'd asked me at that point the odds of the Brexit going through, I probably would have laughed and said highly unlikely. By the time I landed, and it was 1:30 in the morning, and the vote had come out, and we found out that Brexit was going through, and the immediate reaction of the markets, I would tell you that the looking forward, the view of the markets would be one of concern, of volatility, and a real question mark as to what this means for the EU, as well as broadly speaking for the global economy, and the equity market showcased that.
And of course, in the investment world, we don't really like uncertainty. And you mentioned there that we just don't know what all the impacts will be. But are there some indications, or are there things that can be expected reasonably in the short term and long term?
Without a doubt. And as you note, the markets want some form of certainty, transparency, an understanding of where we can forecast going forward from an economic perspective. So if you break it down into three parts, the short-term impact is heightened volatility. The markets are going to react to any news and any uncertainty. We saw it the day after and the Monday after the Brexit vote, but we've since seen an enormous rally. So it's volatility on the downside and also on the upside. In the middle term, we see that planning is much more difficult. Envision that you're the CEO or CFO of a Fortune 500 company, and you do business in the United States, the UK, and the EU. At this point in time, you have no real certainty as to supply chain, cost of goods, will it be using the pound, will it be using the euro, and what treaties and policies will be in place. So if you're in the UK and you're shipping goods over to the EU in 2 years, what should you expect? And that's a real challenge if you're for planning purposes, for budget purposes. And then finally, in the long term, we don't believe that this is going to be a sea change for the EU. We haven't seen thus far that there are other member states that are immediately queuing up to get out. But what we do know is that it's a very delicate, challenging environment for the member states to understand what would that mean. And as soon as one decides they're going to follow the UK, others will want to queue up and get the best deal that they can. So how they handle it, how they handle the Article 50 in the Lisbon Treaty, which is a mere 250 words long, is really going to impact not just the UK, but broadly speaking, the EU.
And Alan, at least in the few weeks since the Brexit vote, bonds have fared well. What can be gleaned, though, from the recent rally in the bond market and continued low rates globally?
No doubt, the bond market saw an enormous rally after the Brexit vote. We actually hit a multi-decade low in the 10-year bond, both in the US as well as in other parts of the world. And as you can see, these bond yields are discounting very slow growth going forward, and a concern more broadly about global economic policy and how it can be forecasted. The 10-year bond got down to 1.36. For perspective, in 1982, the 10-year bond was at 14%. It's incredible to think of the long-term implications of monetary and fiscal policy and where we are today. and what that means. And even in the global environment, when you look at other countries, when you look at Japan with negative interest rates, with German bunds showcasing negative interest rates, that's a difficult environment for monetary policy. And I think, again, harkening back to my original comments on volatility, that makes markets uneasy. It means that policy is less certain, and I'm sure Richard can talk to this, but it certainly makes you question how many tools they have in the toolkit to be able to deliver policy going forward.
And let's go ahead and bring in Regions Chief Economist Richard Moody. Richard, as Alan has discussed, we've seen some extreme shifts in the markets in the aftermath of the Brexit vote. What about the implications for the U.S. economy specifically?
Well, the direct impacts, believe it or not, are fairly minor. For instance, it's highly likely that the vote is going to cast the British economy into recession. But U.S. exports to Britain account for less than 1% of GDP. So even if there's a disruption there, it really won't impact our economy much directly. What we're more concerned with, though, are the indirect effects. For instance, we've already seen in the financial markets, anytime there's a bout of global uncertainty, it leads to an appreciation of the U.S. dollar. That would have adverse effects on U.S. exports and also on U.S. corporate profits. Another thing we're concerned about, to Alan's point, is this creates a considerable amount of uncertainty as to what the future of the European and global economies are going to look like. That uncertainty could weigh on business capital spending here in the States, which would also have an adverse impact on GDP growth. It's not the direct economic effects so much we're worrying about as it is the indirect effects through financial channels and heightened uncertainty.
And Richard, even before the Brexit vote itself, there were some concerns as to the health of the U.S. economy, particularly the labor market. Let's go through some specific segments of the economy and tell us how you assess them, beginning with the labor market. What are your thoughts?
Right, and a few weeks before the Brexit vote, we had the May employment report released, which at the time was reporting the economy added only 38,000 jobs in the month of May. That was the last key data point the Federal Reserve had before they went into their June meeting, which was actually before the Brexit vote. So that really threw the financial markets for a loop, but also I think confused the Fed. And the concern was, is this just a 1-month blip in the data, or is this a sign of something more ominous? And as we found out a couple weeks ago, it was really more just a blip in the data, because we got the employment report for June showing the economy added 287,000 jobs. And this is one of the things we stress all the time with the economic data. You can't put too much stock into any 1 month of data. The data are highly noisy, they're subject to revision, and it's really important to focus on the underlying trend. So in terms of the labor market, that 287,000 jobs we added in June isn't really indicative of the underlying health of the labor market, but neither are the 11,000 jobs we added in May, which is the revised number. So what we look at is really the underlying trend in the raw data. And what that shows us is that over the last 12 months, we've added 2.6 million jobs in the U.S. economy. That's quite a healthy rate of job growth. That's more than sufficient to pare down the remaining slack in the labor market. And ultimately, what we're going to see is as that slack is pared down, we'll see better growth in hourly earnings, which is one of the key signs the Fed is looking for as they contemplate monetary policy.
What about the health of the manufacturing sector as well?
Well, as has been the case for some time now, the manufacturing sector is one of the notable soft spots in the economy. For the last 12 to 15 months, manufacturing has been feeling the impact of the downturn in the energy sector here in the States. It's also been suffering from weaker global economic growth, which is lowering demand for U.S. exports. And that's also one of the key reasons we worry about the appreciation of the dollar, because as the dollar becomes stronger, U.S. goods become less competitive in global markets. So another more recent development is we've seen a downturn in business investment spending. As you can see in the chart here, orders for core capital goods have been declining, and that's reflective of diminished expectations of economic growth. And now you throw in the uncertainty stemming from the Brexit vote, and that could just exacerbate this downturn in capital spending. So we continue to be worried about the manufacturing sector, and it's really a combination of domestic and global forces that are weighing on manufacturing.
Also like to get your insights on the housing market. What are your thoughts about the trends that we've seen there?
Housing market is one of the key supports for the U.S. economy. We're seeing continued growth in new residential construction, although for some people it's a frustratingly slow pace of growth. So it's slow and steady improvement in the housing market. Unfortunately, we're facing a lot of supply constraints right now, which I don't think gets as much attention as it should in the discussion of the housing market. For instance, builders, new home builders, are finding shortages of buildable lots. They've also for some time been bumping up against labor supply constraints. They literally cannot find enough workers to build houses at the rate at which they'd like to build them. And the entitlement process in many markets is becoming lengthier and more costly. So there are binding supply constraints that allow for some growth in new residential construction, but not at the rate we're seeing in past cycles. That having been said, the demand side of the market remains very healthy. Continued job and income growth along with very favorable mortgage rates are supporting demand for home sales. So given the supply constraints we're facing, we think it's going to be more of the same as you see in the chart here. It's kind of a slow, steady grind upward, but nonetheless still a continued source of support for the U.S. economy.
And consumer spending overall, what are your latest thoughts on that?
Consumer spending is clearly the main driver of economic growth right now. This morning, in fact, we got a report on retail sales for the month of June showing another very healthy gain in retail sales, to the point that for Q2 as a whole, we think inflation-adjusted consumer spending will have grown at a rate better than 4%. Now again, that's not necessarily reflective of the true underlying trend, nor is the 1.5% growth we saw in Q1. So as with most things, the truth is somewhere in between. But we think real consumer spending growth of between 2.5% to 3% is going to continue over the next several quarters, meaning consumers will continue to be the engine that drives the U.S. economy.
Let's talk about monetary policy itself as well, Richard. Expectations shifted starkly prior to the Brexit vote, with the FOMC signaling a less aggressive policy stance at its June meeting. In the wake of the vote, though, market expectations pushed the Fed funds rate hike even further into the future. It looks like lower for longer may be in place even longer than we thought. Do you agree?
Well, that could very well be the case. And as I mentioned earlier, what really got the Fed to back off in their June meeting was that weak May employment report. Now, since then, the domestic data have looked better, but obviously the outcome of the Brexit vote has cast a huge shadow over the economy, not only domestically, but globally. So the Fed is taking a very, I think, conservative, and rightfully so, approach to monetary policy. In other words, they feel no need to be in a hurry to continue raising the Fed funds rate. They have time to sit back and wait and see how the dust settles with some of the uncertainty surrounding the Brexit vote.
What are your expectations from a monetary policy standpoint for the rest of 2016?
Well, we're watching the same thing the Fed is watching, and you can sum that up in the chart we're looking at now showing the Goldman Sachs Financial Conditions Index. This is a compilation of a few different factors. It's equity prices, it's the level of interest rates, it's corporate credit spreads, and it's also the exchange value of the US dollar. And so the Fed is really monitoring global conditions to see how that plays into overall financing conditions for US companies. And what happened in the wake of the Brexit vote is we got some appreciation in the dollar, we had stock prices go down, we saw corporate credit spreads widen out, but most of those things have since backed off. And you can see from the chart that even in the wake of the Brexit vote, financial conditions were not nearly as tight as they were earlier in the year, back in February, when there were, again, another round of concerns about global economic growth. And one of the things that makes it difficult for the Fed is that even if they sit back and do nothing, they could still see financial conditions tighten. For instance, it's very likely that by the end of the summer, we're going to see additional policy accommodation from the Bank of England, the European Central Bank, and the Bank of Japan. So should that be the case, that would likely lead to further appreciation of the US dollar, even if the Fed doesn't touch the Fed funds rate, and hence that will lead to tighter financial conditions. So the Fed really is looking at global factors. And one thing that's working in their favor is that inflation remains relatively low right now. So again, they don't have to be in a hurry, even as the domestic economy continues to improve. So what we're looking for now in the wake of the Brexit vote is one hike in the Fed funds rate this year of 25 basis points and 1 to 2 hikes next year. But again, that's going to change with the evolution of the economic data, not just domestically, but globally as well.
All right, thank you, Richard. Monetary policy, of course, has been a hot topic during this presidential cycle. Only a few months remain before U.S. voters go to the polls. Let's bring in Public Policy Manager Chris Scribner, into the discussion. Chris, how do you see current economic conditions and the economic outlook impacting the presidential election moving forward?
Well, I would note that as a recent Pew poll indicates that, typically voters and also this year see the economy, how the candidates will deal with the economy as the most important issue that they identify in voting. That said, that's a very broad sense of where they feel the economy is headed typically as it relates to voting. And that Pew list also shows other more specific aspects of what you could say is economic policy, including healthcare, trade, and immigration. Again, it's important to emphasize that it's how voters think about the economy in the future more than the present impacting their voting. Overall, some other polling and surveys show that voters are generally okay with the economy today, with some uncertainty or worry about the economy in the future. In fact, if we break that down among both Republicans and Democrats, self-identified Republicans and Democrats, we see that the confidence is at its lowest level since 2014. So a trend that if we think about how it might impact the outcome would probably benefit Donald Trump. In addition, voters have indicated with slight advantage to Mr. Trump, 48 to 43, on which candidate they think would better fix the economy. So another opportunity there for Trump. A couple interesting points that I would just note about outlook in the economy. White working class voters are more feel better about the economy today, but are more uncertain about the economy in the future than more highly educated white voters and other groups as well. So that's an interesting split. It's also worth noting because there's a lot of talk and even some ways of trying to relate the presidential vote to the analysis of the Brexit vote, whether that white working class vote is a real how much that will impact the election. And I would say that Trump's, current polling shows that Trump's share of that part of the electorate is about the same as Romney's in 2012. So that would argue that really he's getting the natural share we would expect and not a larger share.
Donald Trump and Hillary Clinton, Chris, in some ways could not be further apart on their ideas when it comes to the economy. Can you give us some more detail or some more of an idea on where they stand on particular issues and any expectations about how they would directly impact the economy?
Well, the second part of the question on how they would directly impact the economy really depends on the overall elections, including for the House and Senate, and that is a broader governance question, the ability for the president to work with the Congress. So we don't have necessarily a clear picture there. One of the areas that Trump really kind of burst onto the scene discussing was trade and immigration, and he's been very and consistently protectionist in his views, opposed to NAFTA, wanting to roll back NAFTA, opposed to a negotiated or currently or soon to be voted on negotiated trade deal in the Pacific, the Trans-Pacific Partnership or TPP. He's opposed to that. So Clinton is a little more open in terms of global economy. I would note, as the slide shows, that she is also opposed to the TPP, although her view, and she supported it when she was Secretary of State, is not that she's against a broader deal with Asian nations, but that she thinks the current deal could be improved. So she's sort of, triangulating, to use a political term associated with her husband. Otherwise, they are very different in terms of tax policy. And we can be much more specific with Secretary Clinton's views, because she has really outlined and detailed very specific plans for tax policy, how she would deal with the shadow banking industry, taxes on high-frequency trading, taxes on short-term capital gains for high earners. So she has very specific policy prescriptions about how she expects to impact, or would expect government to impact, the economy. An infrastructure bank to help drive infrastructure projects in the U.S. Trump talks more in generalities, rolling back ACA or Obamacare, rolling back Dodd-Frank, which is a major, financial reform legislation. So it's less clear what he would do, but they are, as you said, significantly different. Some places of commonality, in a sense where labor on the trade issue has, and potentially the Sanders candidacy, has influenced Secretary Clinton's positions, including a $15 minimum wage that she would put in place for where she could set that and support it nationwide. So some real differences on economic policy.
And beyond economic policy itself, obviously there are so many other issues and key factors determining this election here. Talk about some of the top issues from your perspective, and give us a look ahead as to how you expect those to be part of the debate over the next few months.
Well, really looking at how the presidential election might turn out, we look at very broad factors and weigh that in. The economy is one, and a bit of a draw, or some opportunity for Trump in that regard. One of the crucial variables in looking at an election is, what is the popularity of the incumbent or outgoing president? In this case, President Obama's approval rating is up to 53% and trending upwards. In some ways, that's a response to how unfavorably voters look at both Secretary Clinton and Mr. Trump. They are both unlikable, which creates a lot of uncertainty in the election. We're showing a map that highlights how, one way that the election might turn out. Really looking at the election, probably the most important element to think about is just the structural way we vote for president. We vote by state with the Electoral College. So it's as important in how the voters in individual states view each candidate. One of the remarkable things about politics in the U.S. over the last few decades is how rigid voters have become in their outlook, very loyal to particular parties, unwilling to consider the alternative. And probably the best way to understand which candidate a state will pick is based on what happened in the previous election. And looking at that, and 40 states have voted the same way in the past 4 elections, we have Secretary Clinton with a huge advantage. That map showed her winning 330 electoral votes, which is higher than the 278 needed to win. At the end of the day, there are probably 7 states that are really in play, where if you live in one of those 7 states, you'll see a lot of advertising, and that's where the candidates will focus. Interestingly, those 7 states also have Senate elections that will probably determine which party controls the Senate. So there's a lot at stake in a handful of states, and a lot of states where the presidential election is, or vote, we could predict very accurately today.
And the consensus right now from most polls so far has given Hillary Clinton the lead over Donald Trump. How stable do you see those polls as being, and how might those polls change between now and Election Day from your perspective?
Well, when we think of polls and the Brexit vote, as Alan referenced at the beginning, polls can be unreliable. Clearly, presidential elections are something that we're more used to, and voters or potential voters are more used to, so we can take a little more confidence in polling here. But one kind of golden rule is never look at a single poll and decide that it has meaning. They have to be taken as a group, and really what we're looking at are the trends. We can see now that one of the key trends is that Clinton has consistently held a lead over Trump. At times, he has tightened that, but she has broadened the lead. And what we see is a several percentage point, 3 to 4 point lead in most of the national polls. I emphasize that what really matters are the state polls, the swing states, but we have seen that the swing state polls, those battleground states, are very consistent with the national polls, where again Clinton has a 2 to 4 percentage point lead. Those are very tight. We don't expect those to stay static. There will be things like the conventions where there are opportunities for the candidates to boost their polling. There are things such as the email controversy and the Justice Department's decision not to indict Secretary Clinton, but that will push voters down. So we will see changes. They will start to become a little more immovable, I think, after the conventions, after Labor Day, and then there will be the debates at the end of September that can also move the polls a little bit. One of the other trends that we have seen in the polls, again, is how unfavorable voters see both candidates. And we can see that the voters' outlook has become slightly more unfavorable over time. Trump's have kind of hit a baseline high, very high unfavorable, but they haven't moved much. That really creates a lot of volatility, I think, in the polling, because what's going to be so important at the end of the day in November is which voters turn out. Can these candidates turn voters out? Do they want to vote for their candidate? And that is something we've never seen. These are both historical highs in the unfavorability ratings. So it'll be very interesting for November. But looking at the trends in polling over time, you can begin to understand, the consistency and accuracy of multiple polls.
You think the vice presidential picks will have much of an impact?
Typically vice presidential picks have not had really any impact. Who's going to be the vice president is very much a parlor game for the political class, very entertaining for reporters to write about. Probably, I think the thing that vice presidential picks tell us more than anything is what is the judgment and decision-making process of the candidate, and what are they trying to do within their own party. It's interesting, as I said, in terms of the process, the thought process, the decision-making, but less so in terms of who voters are pulling the lever for in November.
The election itself has already made its mark on the markets, and it's expected to play a role in continued volatility. I want to bring Alan back into the discussion here. Alan, what do you believe we can expect to see with the markets as the election gets closer and then wraps up in November?
Similar to my comments about the Brexit vote, we think that markets will continue to be volatile going into the election in November as the markets try to discern who the winners are going to be, and more importantly, what their positions will be as it relates to economic policy, fiscal policy, and how that plays out then overall for long-term growth on a global scale. And as we know with all markets, any type of certainty in that regard, and to Chris's point as it relates to the battleground states, as we start to get more data in that regard and have a better feel for what the outcome might be or trending, the markets don't necessarily have to like the ultimate decision or the eventuality of it. They just want to be able to plan for it and understand. And as you look at the data over the very long term, the reality is that you should expect a correction every 3 years by 10%. And you should probably expect a 20% correction every 3 years. So it should never be surprising that we have these corrections. We've seen it at the beginning of this year. The market was down over 12% going into the February lows. We've rallied back and we're now in positive territory pretty solidly. And that's a reaction to uncertainty. Things are much worse and then things are much better. The reality is typically they're somewhere in the middle. And we've had these challenges over time. This is not the first time that there have been challenges from an economic perspective, whether it be the Asian debt crisis of the late 90s, whether it be the housing recession of 08 and 09. We've seen these things before, and the market ultimately discounts them. It's a discounting mechanism. It's pricing all of the forward data to be able to understand it. The challenge we see right now, and one of the volatility elements, is that when you look at operating earnings in the S&P 500 and you look at multiples, we're trading at about 19 times earnings. on this year's number, slightly less for next year, albeit earnings aren't expected to really grow, so you don't have a lot of wiggle room. And then add to that the fact that the Federal Reserve is pretty limited as it relates to monetary policy, and you have places like Japan and Germany at negative interest rates. That doesn't create an environment for the markets where there's a lot of confidence. So we envision continued volatility, the sort of reaction we saw on the Brexit vote at 1:30 in the morning where suddenly markets just fall out of bed, what we saw going into February 12th when people thought China's slowing, oil's going from 25 to 10, and then people start to discount a little more and understand the reality of it, and you start to get some substance and a move back to the middle.
So to put it all into perspective, between Brexit, between the race for the White House, all the other uncertainty that we face, how is it that you advise investors in a time such as this?
First and foremost, don't make rash decisions. After the Brexit vote, we met that morning after being up all night as an investment committee to discuss what we should do. And the resounding statement was, stick with our guns. We're well positioned. We've been conservatively positioned going into this. We don't believe that this one vote is going to dramatically impact the global economy or global markets. We think it's a new input and it's something that we need to consider, but don't be hasty. And what we have found with the data over time is that you actually are not well served to go out and sell on the bad news and buy on the good news. Second point would be, remember your long-term goals. Understand what you're trying to achieve and the amount of risk you're willing to take to do that. All too often investors follow the first policy and they do make rash decisions, and it throws off their investment programs, because they find themselves in this vicious cycle and feedback loop where every time something bad happens, they sell into it, and every time something good happens, they buy into it, which is a recipe for weak performance over time. So if you have a long-term investment program that has clearly defined goals and bands around how much risk you are willing to take and the approximate returns that you need, you don't have to worry as much about that day-to-day, the whims and vagaries of the market that might drive you into poor decision making. And then finally, keep communications open with your advisor. Get good counsel. Understand the implications of the decisions that you're making, how it may or may not impact your long-term portfolio. And your advisor is there to provide context and to be able to provide greater clarity on the current market situation and understand how does it compare to the long term. What are the things that may be different, and what similarities may you find? And to borrow from a Chinese proverb, may you live in interesting times. The reality is that there are always going to be these machinations of the markets and the economy. It's been going on for centuries, literally, not just decades or years. And the longer term approach will allow you to have a higher probability of being successful.
Alan, thank you, and thank you as well to Richard Moody and to Chris Scribner for joining us today. And that wraps up the Economic and Market Roundtable discussion, Uncertainty in an Uncertain World. We're glad you joined us for this discussion, and if you'd like more information about Regions, products and services, or if you'd like to discuss investments or other wealth-related topics, just give us a call at 1-800-826-6933. That's 1-800-826-6933. We'll see you next time.